All right, so welcome. We are live. This is inflation, how you can take advantage of it and even profit from it. I am your host, Bronson Hill, CEO of Bronson Equity. We do multifamily investing in the southern US. We work with investors to do that. We got a great panel lined up for us today. I'm going to give a quick introduction and we're going to jump right into it. So maybe you can just drop, if you're watching this live, drop it in the chat box where you're coming in from. If you're watching this on a replay, really excited that you are here. So we have Luke Gromen, who's with Forest for the Trees, LLC. Really excited to have you, Luke. Welcome. And we also have David Morgan from the Morgan Report. Talks a lot about silver and all sorts of other exciting stuff. Today, we're talking about inflation. I want to make a quick note that Mark Moss had a personal emergency, was unable to make it. But typically these events, we have plenty to talk about. And so I'm sure we will go, continue on with much to talk about as far as inflation. Toward the end, we will allow for some questions. We're going to get to that in a little bit. So really excited you're here. So let's just jump right into it. And we'll start with David. David, why are most people unprepared for inflation? And why is it important that we talk about it? I mean, I know it's in the media a lot, but why is it important that people get educated on what's happening right now?
Well, forgive me, audience, as I look at the other screen, but because inflation is insidious, and I would read the definition: proceeding in a gradual, subtle way, but with harmful effects. So why is it, it's been there all along, basically. And why is it important? Because we get to I'll call it an inflection point where you can't ignore it. So, without going into too much detail, there's many ways to define inflation. The Austrian school says it's an increase in the money supply. So you can have an increase in the money supply, but not see an increase in consumer price index, because the increased money goes into, let's say, financial assets, which is basically what's happening. But now we're at a point where we're having a huge contraction in the economy, and most things that people pay attention to, like food and energy, are soaring. And just as a sidelight, I'm sure Luke's got some more insights, but what's so interesting to me is how the CPI has been rigged past the 1980 metrics, where they took food and energy out of the consumer price index. The two things humans need most to survive no longer are meaningful in the way that the government calculates.
Right. Absolutely. And that's one thing that people are really, I think even the mainstream is starting to say, these inflation numbers are just not true. I go to the store, everything costs more, everything is more painful at the pump. It's getting kind of ridiculous, and there doesn't seem to be really any end in sight in this. Luke, can you talk a little bit about, the CPI in general, or just why the government, really can't be trusted to provide good inflation numbers, or why they're incentivized really not to?
Sure. I mean, the incentive, to be blunt, is that bond rates for the government are set off inflation rates. And so if the higher inflation goes according to how they keep score of it, the higher their borrowing rate is going to have to go. And so they are highly motivated to report inflation at more modest levels, both from an absolute borrowing rate perspective, but then also to the extent that they underreport inflation versus what it really is. It allows them to effectively pay negative real interest rates, to basically let inflation reduce some of their debt burden over time. So they have an interest in doing that. It's not anything that is, it's not like our government has a monopoly on doing this. This has been the history of governments, and going back as far back as recorded history. It tends to get worse or more pronounced in times of high levels of government debt, like we're in now. And so that's really the reason they do it. It both from the borrowing perspective and then also from the ability of reducing debt loads via that inflation.
Right. Yeah. It's something that we're watching, and everybody, I think, is, a lot of people don't fully understand kind of what's happened, and the government is still making the claim that this is, transitory, that it's not actually going to change. David, do you have some thoughts on why you feel that, it may or may not be transitory, and kind of what's next as far as the inflation that's here?
Yeah, Bronson. Going back to the definition, an increase in the money supply. So that's continuing to increase. What's so interesting is what's happened in recent times. We've had a 40% increase in the money supply in the last 18 months. I mean, if that doesn't scare you, I don't know what will. And so what does that portend? It portends higher prices for everything across the board. There is a counterbalance between inflation and deflation. As Luke talked about the bond market, the debt or credit markets are the most important factor in the global economy, bar none. There's nothing more important than borrowing money and what the cost of that money is. And because of that fact, if we were to see a free market where interest rates were actually set free to seek the correct level on the amount of risk or payback of the funding money that the governments print worldwide, you would probably see a crash in the bond market, which is actually healthy from the aspect of morally correctness or taking care or doing what the bond market was designed to do, which is to take care of overindulgences throughout the system. That's not the way it works now. So a long answer is, look, we're going to see some areas with very high inflation, mostly in things that we need. We're going to see things that deflate, which are things that really are not needed, and things that are over leveraged, and especially things that have been based on a lot of credit, like the corporate bond market as an example, where these zombie corporations are not making a profit whatsoever at all, yet they've got a debt obligation that they cannot pay. So there's going to be a lot of twists and turns in this market, and I won't go any deeper than that.
Luke, I wanted to ask you, the Fed is obviously there's a conundrum here, right? Because the public outcry against inflation is starting to rise more and more. People are saying my costs everywhere are going up. And yet, really the right move may have been a while ago to raise interest rates or to try to cool things off. Do you think that the Fed at some point makes that decision, or do you think it's kind of too late to go down that road? And if so, what are the consequences of raising interest rates at a federal level or not?
Yeah, I think it's never too late, right? It's all in extremis they can always. But the challenge really is, I think it's twofold for them. The first is it ties back to that point about the size of the debt and also the deficits going on, which is something we've talked about a lot, which is that if you look at what the U.S. government is spending money on, if we just look at Treasury spending, which is both interest expense and stimulus that is helping prop up GDP still. If you look at Treasury spending plus the pay-as-you-go portion of entitlements, that's just the cash out paid to baby boomers and Medicare, Medicaid, Social Security. I look at that as the interest payment on the off-balance sheet obligation of entitlements. And then you just add those two numbers together, and what you find is that those two numbers alone are still more than 100% of tax receipts. And so the challenge is that if they need to inflate the nominal GDP number high enough so that their take of that nominal GDP number, tax receipts, covers their obligations, just the interest-like obligations that they have to pay. And so if they were to start raising rates now with the dollar where it is likely to very quickly lead to a much higher dollar, risk off globally, followed by risk off domestically, given the links that are higher, more pronounced than ever before in terms of how much of the global economy are emerging markets, how much of U.S. assets foreigners own, all of which are at records. And so part of the problem is just structurally, they really need to let inflation keep going for a while still to be able to make the fiscal obligation, just the interest-like obligations, sustainable. If we want to layer on defense spending on top of that, that's another $750 billion. And then if we want to go on or call it 20, close to 20% of tax receipts, then we can layer on everything else the federal government does. And so you can see very quickly that they need to let inflation continue to run hot to take nominal GDP high enough while trying to gaslight everybody that inflation is not running that hot so that they can keep interest rates low to try to inflate their way out of it. And this is obviously called financial repression. This is what we're seeing. The other issue that I think is somewhat unique versus this cycle versus the last 40 years, we'll call it, we probably haven't seen something like this since the early to mid 70s, is that increasingly you're seeing signs that the commodities, and in particular energy and metals inputs that you need to support the GDP growth to earn our way out of this debt, we are not the cost increases needed to spur the growth of production of these commodities is rising meaningfully. There was an article in the FT today, or yesterday, excuse me, talking about how the Bakken shale is probably never going to surpass its pre-pandemic output. And so you've got these structural commodity price increases that the Fed and other central banks can do nothing about. And in fact, which they need to let run to spur more discovery production of these commodities, just so that the economy can actually pay back the debt that already exists. So they're in a pretty big pinch from a couple of different structural factors in terms of needing to let inflation run while simultaneously trying to maintain their credibility that they've earned over the last 40 years as inflation fighters.
Right, David. What do you think? What do you think the Fed is going to do as far as timing? Are they going to raise rates? Are they not? I know you're a metals person, so you obviously have things outside of that. We'll get into that in a bit. But talk to us a little bit about just kind of building on what Luke had shared.
Well, great insights. And the Fed is reactive. They don't get ahead of the curve ever, in my experience. So they may be forced to push interest rates up, and really they don't have as much power as most people think. I mean, they have the discount window. They can set that. Banks take other interest rates off of that. Everybody looks at the 10-year, which is the stalwart of how you judge other interest rates, mortgages as an example. But they are between a rock and a hard place. As Luke said, if it goes higher, then the debt service becomes unbearable. If they can maintain the financial repression, meaning that they're getting cheap money, in fact, they're getting negative interest rates in a real sense, because true inflation maybe is 9%, and yet they're only putting out, 2% or so on the 10-year. So it's helpful to the government to inflate this debt away and pay it off with funding money. The problem is, in all previous history, when that starts to take effect, and it's taking effect, let me restate that, as it takes effect, more and more people wake up to that reality and start to hedge themselves or make adjustments, which means a run to gold, basically. And that's what the last thing that any of the central bankers want, although they all have it and they use it on their balance sheet and it's a tier one asset and yada, yada, yada. You never hear that on the financial mainstream channels.
Right. So, it's interesting in this season. I mean, most people that are alive, really haven't lived their adult life during times of high inflation. It's been really over 40 years since we've really had significant inflation, and it seems we're at the door. We're already there, and there's a lot of shadow stats or other things that would say inflation could be as high as 15% right now. We're really not sure exactly what it is, but I think the question that everyone's asking, at least it's here or watching this video or this chat, is, what is it that I do? Where do I put my resources? Obviously, we're not giving any specific financial advice, but what are some things to consider? Maybe we'll start with Luke and then go to David.
Yeah, I think it's you have to go back to the 70s where people that lived through that and people that invested through that would recall, I don't know if it's fondly or not fondly, but they recall calling bonds certificates of confiscation. And for the last 40 years, we've been in this bull market for bonds, much of it in real terms. I would argue the last several years, it's probably not been in real terms. But I think rule number one is that basically, I think you need to start thinking of bonds as certificates of confiscation again. And that won't always be the case, given some of the differences now versus then. Some of the it's such a political process. We're starting to see there, as you referenced before, Bronson, some of the political and David, the political outcry is actually starting probably more than I've seen in my lifetime in the last, call it 3-4 weeks. It's been pretty pronounced comparisons of the Biden administration to the Carter administration as it relates to inflation. And I don't know if that's right or not, but there's an awakening happening. And so you're going to get these political fits and starts where the people, you'll see sentiment switch back to, the Fed's going to tighten significantly. They have to stamp out this inflation. And there will be periods of time when bonds outperform stocks and gold and harder assets that do well under inflation. But I think from a secular standpoint, I think we're watching the early days of the end of the $40 or 40-year bull market in bonds, where I think you have to start thinking about bonds as certificates of confiscation in real terms. Not to say rates have to rise a whole lot. I don't think they will rise a whole lot. So I don't think you lose a lot of money in real terms. I don't think they rise a whole lot because I think ultimately the Fed and other central banks can be forced to cap them via some version of yield curve control. But I think that's a key step, number one. And then it's once you get that step done, then I think it's an understanding. All right, do I want to own some productive real estate? Do I want to own ideally with a long dated fixed rate mortgage and have that certificates of confiscation working in your favor? You want to own some gold, you want to own some silver, you want to own some, in my opinion, Bitcoin, you want to own different commodity or industrial equities. And I think that's how you have to think about what appears to be likely to happen in terms of inflation and what the government needs to do in terms of that inflation to get out of their debt position.
Right. David, what are your thoughts?
Oh, very similar. They're not going to do a lot. They're going to be forced. They will, I agree, probably cap interest rates or, do a swap. I mean, they could go as far as saying anyone that has a Roth or an IRA of some type is required to put 25% of their contributions into long debt. Otherwise, you can't keep it. I mean, who knows what they'll come up with? I mean, governments get very, very interesting at the end of these great inflations. I do agree that they should be thought of as certificates of confiscation. And I also just add, I think this will hopefully help people, is that if you don't trust a dollar today, then why would you trust one 2 years out, 10 years out, 30 years out? The problem being, of course, is that the dollar will have the last say before the end. What does that mean? It means every other currency in the world, especially for people that don't know what a stock is, they don't know what a bond is, the people that still have to have money to survive. If you're in Argentina or any of the South American countries, you're in any of the Eastern European countries, even Europe, when your currency is failing against the dollar, the run to the dollar will keep the dollar strong for some time. And this goes back to Exter's pyramid, the debt pyramid, where the liquidity squeeze as the derivatives market starts to implode and a lot of this bad debt in the corporate world starts to implode and some of the real estate that's been over leveraged starts to implode, you seek safety. And safety, the safest thing known to most humans is a piece of currency, and the best currency known to the world is the US dollar. So I'm not a negative dollar, I'm just negative fiat. I know all fiat fails, but the dollar will be the last man standing. Once there's enough, as I talked about earlier, and hopefully I was clear, that it doesn't have to be a majority at all, but there has to be enough money that moves one way or the other outside the dollar as a hedge. It could be precious metals, it could be energy, it could be housing, it could be a lot of things, but exits the dollar in enough of a small time frame that it causes a wake-up call to others. I've talked about this before. There's a movie called Rollover that kind of does a dramatic overview of what could happen in the future. I don't think it'll get that bad. Of course, governments will do their best to mitigate it, but there's not much they can do. Once the herd wakes up to the fact that the dollar is doomed longer term, there'll be a lot of adjustments. Some they'll be able to control, a lot they'll try to control, but a lot of it will be outside of their control.
You bring up a really good point. I think a lot of investors today really have trouble thinking outside the dollar, that the dollars, you have an asset or you buy something and it's converted, back to dollars, right? So you have real estate, it provides, something that you're able to get cash flow and get fiat for. Same with, even with metals, treating metals more as an investment rather than money itself. David, I know you're a metals guy. Can you talk to us about, do you think there's any risk that if it gets bad, the government will try to restrain people from owning metals? Or do you think metals will have the place that it had, previously as kind of being a monetary standard as it's been for many, many, many years?
Neither. I do not think that the government will confiscate gold or silver. If you're worried about that, then the best thing to do is invest in gold and silver that's from their mint. In other words, if you're U.S., buy U.S. Eagles, silver or gold Eagles. If you're Canadian, buy silver maples, silver or gold. They cannot confiscate their own money, their own currency. That's really money from my definition. So that'd be one way around it. If they are going to do it, they could take all the silver in the world, and what is it going to do? Absolutely nothing. Why? Because the silver market is 0.02% of the entire financial market. Whoop-de-doo. All right, let's take all the gold. That's 1% of the financial markets. Whoop-de-doo. All right, let's multiply gold by 10 times. All right, it's 20,000 an ounce. We've heard those numbers from people. All right, now you've got 10% of the financial market. Whoop-de-doo. So I don't see confiscation. I really don't. If they were, though, I'll add this because I've been asked this many times. They're not coming to your house. They're not going to knock on your door and ask you for your Kruger ads. They would go to the ETFs. They would go to the exchange traded funds. This is bullion deposits, and they would take that. They wouldn't take coins. They wouldn't take private, almost certain. And remind me, Bronson, of the second half of the question. I'm sorry.
Second half of the question, let's see, we're talking about metals and I guess the place in monetary, historically metals have been a place that, it has been money for 5,000 years. So is there ever something that
would it come back into the
would it come back to a monetary?
And the answer is I doubt it. It will in the free market. You're already seeing cryptocurrencies that are gold and silver backed. You're seeing, gold money. There's a lot of platforms that you can reinstitute honest money, but it won't be sanctioned by government. But I will give an edict. Too much respect for Mr. Gold, James Sinclair. And there could be, during this reset process, a rejection of the first reset. That's what James Sinclair has indicated, he and Bill Holter. And if that were true, their backup plan would be, okay, well, we tried to fool them once, let's fool them again. So we will go to a second round of the reset. And this time you're partially backed by gold. And that would, calm people down and, they would accept the reset. So answers I really don't know, but I really doubt it. Silver? No, there's no way that they're going to use silver as a monetary asset officially because it's too scarce. It's too precious. It's too rare. In order for it to have any impact whatsoever at all, you'd have to push the silver price to such an astronomical level in paper terms to be meaningful. And no one's going to do that. The market on its own may do that, but the government certainly.
Yeah. Luke, I wanted to ask you, I know scenarios, people play out different scenarios and think if interest rates rise, so going back to the Fed at some point needing to raise interest rates, does that cause an overall crash of asset prices, such as real estate, cryptocurrency, and the stock market? What's your kind of view on that?
In a vacuum, I think it would be very bad for all those assets if they do it. If they did it today, as the U.S. fiscal position stands now, I think you would see the dollar rise sharply. I think as the dollar rises sharply, you're going to start forcing international selling. You go back to 1998, the United States net international investment position, which is just the net of how much we own of their assets versus they own of ours, was negative 3% of U.S. GDP in '98. So when you had the emerging market blow up in the late 90s, the way to think about this net international investment position, practical terms, as it relates to U.S. assets, is it's how long the fuse. It's an inverse of how long the fuse is. So a small negative net international investment position for the United States means it takes a long time from an emerging market blowing up to when it shows up in U.S. markets. And so in '98, we were negative 3% net international investment position. In September of '97, by summer of '98. You had the United States ISM index in a recession. So you had an industrial recession 8 to 9 months later. So pretty long lag there between blow up in EM and that. 2008 net international investment position in the U.S. negative 8%. Now it's negative 70%. And so what that means is in a world where the dollar is the reserve currency, foreigners have borrowed a lot of dollars. If the Fed raises rates too soon, you're going to strengthen the dollar. That strength of that dollar is going to start to force. It's going to start to make the dollar-denominated debt harder to service in foreign markets for people that have borrowed in dollars. And so they're going to sell what they can, which are their US dollar assets. They own $40 trillion in dollar assets on a gross basis. Call it $15-16 trillion on a net basis, which is that net negative 70% of GDP. And they'll start to sell those assets aggressively until they satisfy their dollar requirement. And so critically, that'll then spill into U.S. consumption markets, since we've done work with the IRS data showing that net capital gains plus taxable IRA distributions in the U.S. alone is about 200% of the annual growth of U.S. consumer spending, which is 70% of GDP. So basically, it's not to say people are selling stocks and buying boats and cars and everything that's in the PCE category. But what it does mean is that mathematically, it's impossible for U.S. consumer spending to rise if stocks are falling fast enough, if assets are falling fast enough and staying down. And if consumption's falling, then GDP's falling. And so you quickly go into this spiral that hasn't been there for really any of our careers, because if GDP starts falling, remember that gap between the obligations of entitlements and treasury spending relative to tax receipts. Tax receipts start falling, you're not going to see any drop in these entitlement obligations. If anything, they're going to rise due to countercyclical payments. And so you end up with what we've started to see in the United States since early 2018, but it really came in late 2019, which is in big stock market downdrafts, we've been starting to see U.S. Treasury markets sell off with stocks. In other words, we've been seeing increasingly since 2018, the TLT, the long bond, the United States long bond, the safe haven asset, going up in yield as stocks go down. And that had never happened in my career. It has never happened really in most people's careers over the last 40 years. You saw it even earlier today. The head of the New York Fed came out and said, we need to shore up the Treasury market ahead of the next big shock. You say, why would you need to shore up the Treasury market ahead of the next big shock? It's the world's safe haven asset. And the answer is they've got a supply-demand problem that would be touched off by the Fed raising rates prematurely. So to me, raising rates too soon is likely to be very problematic and would be manifested in a stronger dollar, followed by emerging market risk off, rest of world risk off, U.S. risk off, U.S. recession. And then it just depends when the Fed wants to get back in and say, whoops, we screwed up and we're going to start growing the balance sheet for, another 3 trillion or whatever the number is. Because I think that would be the inevitable outcome of that.
Right. No, it's an interesting, there's a lot of moving parts in all of this. One development that I found very interesting is really the explosion in value of crypto. The crypto has become, so valuable over time, even large institutional firms going into this. Maybe Luke, can you comment just on your opinion on crypto as an investment? Again, we're kind of this whole session, we're talking about, where people can put resources. Do you recommend people start to get into crypto? Do you say, they should avoid it? What are your opinions on crypto?
Yeah, I like Bitcoin. I like it a lot. I think Bitcoin is effectively a neutral reserve asset for the people that has an energy tied to it. If you look at how it is structured with the algorithm and having to expend energy to create the asset, it's effectively energy tied in that way. It was fascinating, and I kicked myself a little bit. I've owned Bitcoin since about second quarter of 2013 when Coinbase was launched, and have it's done well. Nobody's owned enough of it. Most of all me. It's always been a small position. So, but with that said, it was interesting. In 2016, I had a dinner with at the time, one of the biggest physical gold traders in the world. We'd been introduced by a mutual relationship of ours. And I guess this was summer of 17, the summer of 17. So unsolicited, this physical gold trader says to me, well, Bitcoin's just doing what gold would be doing if it didn't have the gigantic paper derivative market attached to it. And it was fascinating because I had been saying that to people, said, boy, this Bitcoin's really acting like gold, like gold would if they didn't have this unallocated gold market that just expanded forever in London. And so for someone who was in the absolute thick of it to say that to me was really fascinating. So for me, I look at Bitcoin in particular, and I don't think Bitcoin's a bubble. I think Bitcoin's the last functioning smoke alarm of what's going on. It's the last sort of true, honest market. And we sort of forget what that means, but part of what a true honest market means is what we had yesterday, where you wake up and Bitcoin's down 7%. And it's very difficult to stomach, and you need to manage your position sizing appropriately for your risk tolerance, your age, all those things. But for me, I think it's an important part of a portfolio from the standpoint that it is the way it is structured. They have tried and they were unsuccessful. Policymakers tried and were unsuccessful in neutering Bitcoin in the way they have neutered the price action in gold, which is allowing the expansion of unallocated paper derivatives to basically siphon demand off of physical gold, right? Effectively, what they have done to manage gold's price over the years, last 35 years, has been if money supply grows, and in theory, gold price goes up, but if they can grow paper derivatives on gold as fast or faster than the speed at which the money supply grows, then they can manage the price of gold through the expansion of those paper derivatives rather than through the expansion of physical gold's price. And they've proven so far unable to do that with Bitcoin. And so to me, Bitcoin is it's like I said, it's just the last honest smoke detector. I don't think it's a bubble. I just think it's telling us the truth.
Right. Robert Kiyosaki, I think he calls, gold as God's money, and crypto or Bitcoin is like the people's money. David, what's your opinion on crypto? How do you feel about it?
Oh, I'm sort of slightly bullish. I love what Luke said about the derivatives market of gold. Thank you for that. It's one of the best explanations ever. We have, taken the Kool-Aid, so to speak. We have been following the blockchain for quite some time and reported on it monthly for years. I wrote an article in 2014 about my take on Bitcoin. We do have Ethereum in the portfolio. I'm not as strong an advocate of Bitcoin, but I'm free market. Look, if you think that's the best, and perhaps it is, the market knows more than me. We're good on XRP. We're good on Ethereum, and we put these in as a speculative part of the portfolio. When I put it on the list, you've outperformed using Ethereum versus Bitcoin. So in other words, put $1,000 in Bitcoin or Ethereum, you'd be happy you chose Ethereum at the time I formally recommended it. But also, I want to backtrack a little bit and take a vector. I don't want to take too much time, but Luke's obviously doing a great job. So are you, Bronson. But one thing I don't think that gets talked about enough, we talk about debt and the money supply and foreign currencies and emerging markets and all stuff. It's very important. But what people don't understand is that the whole thing runs on energy, 100%. There isn't a global GDP without energy. And a barrel of oil is equivalent to about 23,000 man hours. So you're not going to get the population increase from 1900 to 2021 without that oil. And we're at the point of where we're nearing the peak in my studied view. And so things are going to cost more. Food production based on oil, fertilizer based on oil, all these things. And I think that's part of the equation that we really have to think about deeply, because if we had to price food, transportation, you can name anything in the price of labor, of man hours, it'd be off the charts. Now, I'm not suggesting we do that. What I'm trying to suggest is that oil is probably underpriced. When you look at the labor cost for a barrel of oil is $164,000, and we're paying about $80 for it. So you're not going to get somebody in China to take 4 people with all their luggage, 2 miles to the hotel for 25 cents. But an automobile will do that. So I think this is a part of the equation that a lot of people overlook. And I'll shout out to a friend of mine, Steve St. Angelo. Steve, I think, does the most work in this area and relates it to precious metals investors and other investors, of course. It's across the board, but most metals investors are concerned with currency, money supply, and things that it's outlined, where really, if you get down to it, there's one commodity that's above all the rest, and that's energy.
Right. There's a book I read called The Moral Case for Fossil Fuels. And it basically makes the same point that, when you have fossil fuels or energy use, it leads to a better life, and it really leads to more production basically in every way. And it's really interesting now with all these green deals to try to, reduce significantly the amount of fossil fuels or other sorts of, and I'm not just saying we should pollute or those type of things, which people, kind of think that if you read the book, it's actually a very intellectual way of looking at it. But, Luke, do you have any thoughts on basically the energy market and kind of what we're seeing and how, again, this ties in with inflation and kind of maybe where energy is headed just as a whole?
Yeah, I think David made a great point. We've written quite a bit about it over the last several years, really, but we've revisited it in the aftermath of the COVID crisis last year, starting really in the third and fourth quarters of last year. Started talking more about what we call peak cheap oil, which is same kind of concept. Which is, if you look at the last 15 years, really by far the biggest marginal supply of oil in the world came from U.S. shale. And if you look at what U.S. shale has done out of necessity, they high graded all of their best locations just to keep productivity and cash flows up through the sharp cycles they've had. Depletion, or excuse me, decline rates in the shale are extraordinary, 5-6% per month. And so it's a very difficult taskmaster. You've got to run very, very fast in the U.S. shale just to stay even. They were able to do that by high grading their best locations, but now those high graded, those best locations, most productive locations, have been discovered, produced, depleted, and are sort of in the long tail of low levels of production. Excuse me, in a lot of cases, and so they're left with B and C locations, and the challenge is the installed base is now so big, as noted earlier. Article in the FT yesterday talked about how Bakken might not be able to ever be able to exceed pre-pandemic levels again, which at least not without significantly higher prices. And for me, you think about what's that mean for financial assets. To David's point, implied in energy is the master discount rate. It doesn't matter. The central banks can tell us interest rates are whatever they are. The ultimate discount rate is the price of energy and the energy return on invested energy. So if you're putting 1 barrel in to discover 100 barrels, you've got a very low discount rate. If you're getting to shale, you're more like 8, 10, 12 barrels out for every 1 barrel in. And then you start getting to some of the more ESG, environmentally friendly applications, it's lower than that. And so what you're really effectively doing is raising your economic discount rate in terms of all of your assets. And so all financial assets, all assets in total. And so implied in the price of every single asset we own, touch, use is assumed a plentiful and growing supply of cheap energy, all the way down to suburban America. You think about it; the suburban America only exists because oil was cheap and plentiful. And so, if you start assuming, as what the data suggests, which is oil has to be increasingly not cheap in order to keep it somewhat plentiful. You're raising the underlying discount rate of the entire asset base out there. And so there's two ways to deal with this if you're a central banker. The first is you can let the economy right size down, deflate to whatever is implied by that raising energy discount rate, the energy return on invested energy. The problem is that is politically and economically unpalatable given the debt outstanding. And so the other option is you basically have the central banks start to fully reserve the debt over time. And what central banks fully reserving the debt over time to keep it nominally money good looks like is, call up that chart. We can find it on Bloomberg, of aggregate central bank balance sheet going back to 2008, 2010. And it's up and to the right. They're all buying, taking turns, or all at the same time, buying debt and inflating money supplies, trying to effectively, what they're doing ultimately at the crux is papering over this issue that David was talking about, which is the rising effective discount rate on a real basis of the global economy that is being driven by these by peak cheap oil and higher cost sources of energy. So I think it's an enormous deal. One way or another, it implies, unless they're willing to deflate the economy, which you could in theory have a deflationary but very politically messy outcome. To me, when you see them basically trying to paper over by growing the central bank balance sheet, to me it pretends an ongoing inflationary, secular inflation. But I think most policymakers and economists are still not looking for it. You still hear them saying over and over that medium to long-term inflation expectations remain anchored. They remain anchored. They remain anchored. And I think we're probably within a few months of those medium to long-term inflation expectations becoming unanchored with this energy point that David made a key point of that, or key part of that.
Yeah, no, that's a really great point. Energy, obviously it's you have a very I don't know if you were an analyst in your past life, but you have a very amazing way of explaining everything well. So thank you for that.
Well, thank you.
And we're going to get into questions here in a minute for those that are live. So just kind of be prepared with your questions. We're going to get those in the chat box in a few minutes. Wanted to kind of go, our business, what we do is we work with investors to buy large apartment buildings, and people have a decision how much they want to allocate to a certain thing. So if they have a $5 million net worth, they want to put 10% in, they figure how much, sometimes 10, 20, 30, 40, 50%, sometimes even higher. And I think I used to be an investment advisor, and that's a question that we really can't tell anybody specifically. Here's how you should allocate, unless you go traditional stocks, bonds, that kind of thing. So we're not giving anybody any specific advice. But as far as allocations, what do you see? Anything you can give, maybe about your own personal, investing and what you do. It's just, I think it's really, really valuable to ask panelists of this event, just kind of what's your allocation kind of looking like now? Maybe you can start with David and then come back to Luke.
Sure. I just actually did an interview this morning on something I'd written for the 10 Rules of the Investing Rules book. I don't think it's published anymore. It came out of the UK. It was published every year. They looked at top investors across the board: insurance, stocks, mutual funds, limited partnerships, options, you name it. Very thick book, and you only get like 2 pages in the book. Had to be pithy and very precise. And in the 10 rules of silver investing, rule number 10 was too much of a good thing is too much of a good thing. And I recommended 10% precious metals. But the studies that have been done.
So real quick, you said 10% precious metals?
10% is what I said.
10%. Okay.
I upped it to 20% later. It's another story. But Ibbotson and Associates did a study independently on portfolio management. And they came to the conclusion that under normal conditions, 15% was the right amount of precious metals. And under adverse conditions, it was more like 20%. Lastly, Jeff Christian of CPM Group did a study from 1968 to present day, or almost present day, I think to 2018. And his number was 25%. So obviously, anyone that goes all in gold or all in silver or whatever is way overweighted. But it's in those categories based on independent studies. So what's the right amount? Individual choice. But I do believe if you don't have some exposure to the hard asset class for what I see coming down the pike, I think you're going to wish you had. And so there's a balance there. And of course, that balance is where for everybody it differs. Certainly silver is a higher risk profile than gold, but it also has a higher reward profile in inflationary times, or at least it has in the past. Now, with crypto in the mix, there's an alternative to the precious metals. My only concern, I guess, is that it is an asset that's based on a high-tech environment. That's not wrong. I mean, your stock account's based on the computer somewhere in a brokerage house. So is your bank account, almost everything we consider to be quote-unquote money, based on the electronic system. Hard assets don't have that. They are the means of payment of last resort. So to have a bit of that's probably not a bad idea, especially if we are facing, let's say, energy problems in the future where you could, I'm not saying would, I'm using the word could, have intermittency throughout the grid in, let's say, certain areas due to allocations of pumping water, communications, satellites out, earthquakes, weather problems, you name it. These things exist. So I'm a big fan of chance favors prepared mind. I think if you have the correct diversification and a balance that suits you, it comes down to that own self be true. It applies to investing as well as other aspects of life. I'll turn it over to Luke.
Yeah, Luke.
Yeah, I'm very much I don't trade a whole lot, so I feel I invest where my high conviction is. My high conviction is this. Structure my portfolio so I can withstand the volatility, so I don't have a lot of leverage, but I feel very confident that we're in an inflationary regime. And so I've got, call it, about a third in a combo of gold, Bitcoin, and gold miners. I've got about a third in a couple different kinds of residential real estate, and I've got a third in a variety of different equities, primarily industrial type, industrial equities, some commodities blended in there with some ETFs, what have you. Roughly a third. I mean, it's probably 30 with some cash, just for the optionality, having that cash when things move, and I'm looking to pick up some bargains. And I think too that probably one of the best investments you can make these days is having either a small business or your own small business. I think that gives you, when you talk about the great optionality, the ability to I guess flexibility, but then also just that, it's an area where there, I think, is a lot of growth opportunities depending on the business, given some of the broader trends. So I think that can ultimately be really good investments as well. But again, I think it's something that when you look across the liquid part of the portfolio, it's call it a third between those three.
Yeah, I met a guy. I was at a event this weekend. I met a guy who said he was 100% invested in Bitcoin, and he started in 2016. He sold his house, put all the Bitcoin. He's done very well, but he was just trying to tell me it was the best thing. But I think really, it comes down to human behavior. It comes down to things that, we don't necessarily know how things are going to. Having some diversity obviously is important. We're going to jump into questions in here in a minute. So we're going to jump right into that. Also want to mention George Gammon, a friend of ours that has basically calls it the 10-80-10 allocation, where you have your cash reserves and then you have basically of your investable assets, 10% in gold, 80% in productive assets such as real estate, something like that produces, they basically pay you to hold them, and 10% in speculative stuff like crypto or gold mining stocks or other things. So there's some unique ways out there, and there's a lot of people talk about allocation without giving specific advice, because we can't give you any specific advice without giving a disclaimer. So we're going to just jump into questions here. So if you are live, go ahead and just drop your questions in there. It can be stuff that is a little more complex or something that's a little more simple. We'll take a few minutes of questions. So this is from Charles. Why is the market seems impervious to easing, dollar spiking, or threats of tightening? So yeah, why is the market basically ignoring kind of, if we are to tighten or there is a dramatic change? And either of you can jump in.
It's something we've talked about. I think there's sort of two reasons or two possible explanations. One thing I would highlight is when you look at what the Fed has established with this, what they call a standing repo facility, and then also these foreign swap line or foreign repo facility. What it looks like they are doing is effectively tapering liquidity, so that if you think of QE as injecting a syringe of liquidity into your left arm, they are, they're starting to inject less liquidity into the left arm. However, what this standing repo facility and the foreign swap lines amount to are basically setting up an IV drip in the right arm that pulls liquidity as needed to try to sort of smooth the process. And so basically what these repo facilities do is, if you are a domestic right now on the domestic standing repo facility, it's a big bank. It's the big banks, the primary dealers. They're talking about expanding that to other banks. But if you need dollar liquidity, you can, instead of selling treasuries or otherwise selling assets causing disruption in markets, you can go to the Fed's repo facility and pledge those assets and get cash on demand, basically pawn those assets to the Fed to get cash as you need, to basically try to keep the cash, the dollar liquidity within markets from causing a problem to markets. And so I think that's been part of why it hasn't. I equated it to fake taper, right? Is that, hey, we're tapering here, we're doing this, the real highly visible part, and with this alphabet soup of repo in the domestic and foreign markets, doing some things to re-inject liquidity back into the system on the QT to keep markets from being disrupted. Now, with that said, you're still seeing the dollar rise. I think I don't know what the magic level on the dollar is, but I think there is a magic level on the dollar. I wouldn't be surprised if it is below where we saw the dollar hit in March 2020 during that crisis, which was 98 to 100 on the DXY. So, let's see. I think so far these other supplemental liquidity measures that have been put in place may be helping to prevent prevent or keep the dollar liquidity where it needs to be to keep markets from taking taper maybe more badly than they otherwise would. But part of it might just be it just hasn't been long enough. There may still be lags working through the system.
Yeah, that's a wonderful answer. Thank you. So a question from Lisa is talking really about hyperinflation and the reset. And I think it's interesting. There's a guy named Klaus Schwab from the World Economic Forum that talks about the Great Reset, wrote a book about this. There's people kind of right and left, depending on where you are, that talk about this idea of the reset. David, can you just touch base, maybe go into that? Do you see this kind of some of all of this ending in hyperinflation? Do you see it, forming some sort of reset? What do you kind of see all of this heading, kind of the end game of all this?
Yeah, it's a tough call, but first of all, you really have to define hyperinflation, and I won't. I'll stab out. I'll say anything above 20%, and maybe 20% official. You said something earlier, Bronson. I'm certainly not going to take anyone to task too much respect, but you said something about the inflation isn't really there. The inflation really isn't acknowledged, is how I would have said it, because when my daughter was her first semester of college, I paid the fee, right? And she had a scholarship and still wrote a big fat check. And then the next semester it was up 25% from what so this is the real inflation. You go to the hamburger index. I don't want to digress too far. So let's go to the hyperinflation. In advanced capital markets, the bond market is kind of the governor to the whole economic system, which means that the price of money, as we talked about before, and Luke's done a great job, probably better than me, is as things unravel and these corporates that I call zombie corporations can't pay their debt, they fail. And there'll be a point in time where the Fed just refuses to bail out everybody. So that's highly deflationary. When you have all kinds of corporations, especially ones that like Luke's invested in, I'm not saying you're in the wrong place, I think you're in the correct place. But if you have absolute needed industry that's failing because they can't make their debt service, then you're contracting the economy greatly, and that's deflationary. It's also deflationary in the aspect of interest rates, because if you spike interest rates like happened in 1979, 1980 under Volcker, the bond market crashes because there is an inverse relationship. As interest rates go higher, it's the cost of money, and it also is risk. And this is where yours truly made a huge error. And I've admitted this publicly before. I was overeducated. I mean, I studied monetary history quite well, and I was in the camp of the hard money, honest money gurus. And when you see an 18% interest rate, yeah, that looks like a great amount of return, 18%, but that's also mafia money. I mean, we've never seen anything like that in the United States Treasury market ever in all of recorded history. And I was fairly well convinced at that time that we might have a currency crisis right then and there. And I couldn't have been more wrong. The best place you could be is swap your gold into the long bond and clip coupons and watch the interest rates go down to almost negative for 30 or 40 years. That doesn't mean it'll happen again. So I don't see hyperinflation. I think there'll be too much destruction throughout the bond market, corporates, and the treasury markets and foreign markets. I think there'll be a resettling, and there'll be all kinds of games and twists and turns and rhetoric, and I'll just stop I'm almost done. And you'll see the front men come on up and try to quell markets and tell you it's all under control. There's nothing to worry about. We're going to put the 30-year treasury at 100-year. We'll move it to 100 years, and we're going to guarantee an interest rate of 1.5%. So just settle down, folks. There's nothing to see here, and try to move on. But we're in a mess. It's going to unravel. I don't see hyperinflation. In some areas you could point to, say, oh, it's hyperinflation. There must be hyperinflation in some of the energy sector or maybe some food price or whatever. But on aggregate, no, I think you're going to see stagflation. Everything that's meaningful to your life, like food, shelter, energy, your utility bill, your insurance payment, your education, all of that's going to cost you more and more and more. And your real wage that you're going to get in your back pocket is going to be worth less and less and less. But I don't see where you're going to see the currency worthless, although the psychology could go that way. And if the psychology goes, oh my goodness, the dollar is going to become worthless, you'll see a run to gold like you've never seen in all of history.
Yeah, it's very, very well said. Really appreciate it. That's very well said. Luke, what are your thoughts? Anything you'd like to add to that piece?
I agree. I don't think you'll see a broad-based hyperinflation in the U.S. in part because at the right price of everything, we can make pretty much everything we need. Which, when you look at these great hyperinflations throughout history, there have been, Weimar Germany was completely deindustrialized by the war reparations. Some of these other smaller nations were running massive deficits and didn't have any. No matter how weak the currency got against stuff, they were importing all their stuff. And so they were just chasing a dragon they would never catch. And that's not true in the U.S. Perfect example is the dollar collapsed 90% against oil from 1999 at $12 or whatever it was to $150 in 08. So in less than a decade, the dollar collapsed to 90% against oil. And what we got out of that was an extra 15 million barrels a day of shale on a lag, critically on a lag. And I think that's the important point where when the central bankers, when the Fed officials say inflation's transitory, it's a little disingenuous because all inflations are transitory. I mean, the Weimar German inflation was transitory. It went for 4 years, it destroyed the currency, and they moved on. So, to me, the question is that lag. We are running twin deficits. We used to have foreign financing of those twin deficits. We largely do not have foreign financing of those twin deficits any longer. Those foreigners are instead buying our equity. So basically, where the deal used to be, we run deficits, we export dollars, and they recycle those dollars into our treasury mortgage markets. What's largely happening now is we run deficits that are bigger than ever before. We send them the dollars, and they buy our real estate and they buy our equity. So basically, instead of selling treasury bonds, which are just sort of created out of thin air and are IOUs, we're now selling actually finite American corporate America real estate to, in some cases it's the Germans and the Japanese, and that's fine. They're our allies. In a lot of cases, it's to China and other places that may not exactly have our interests at heart, our best interest or our political interests aligned. Maybe we'll put it that way. And so the point is that the twin deficits are there. The lack of foreign financing is there. So you have the recipes for a very vicious inflation. You've got the inability to cut the deficits in terms of the entitlements, the treasury spending, the defense spending, everything else. The dollars are still flowing back into our equity market because we're basically swapping, imported goods from China for shares of Walmart and Procter & Gamble and all these things. The challenge will be is if the dollar starts to weaken, what's the lag time until, if there is concern, if the dollar gets too weak effectively, that it starts to offset the rise in the stock market. And if that happens, right, because right now those dollars are being recycled into the stock market, the dollar is stable enough, it moves up, moves down, it's in a range, they're still earning a positive real return. If for some reason we end up in a situation where the weakness in the dollar outpaces the strength in the stock market, or if the stock market falls or just stops going up, you're going to have this question of, will the money start to leave? And then if the dollars start to leave, then you're going to get into a high period of inflation. As you get into that, then it's a question of how weak for how long does the dollar have to get before we start building more stuff on our own. And there's probably quite a bit of a lag there. So for me, I don't think we get a hyperinflation, which as I define it as IMF 50% per month, I think is how they look at it. It's a very, very high. But do I think we could see something like they saw in Israel in the early 80s where they had been we've been deindustrialized. They didn't have a big industrial base. They had too much debt. They had these pensions they needed to reform. You saw inflation of 200%, 300%, 400% for 2-3 years, and they inflated away the debt, and then they raised rates and they reformed pensions, and away they went. And obviously, people always want to point at the Zimbabwe's and the Weimars and the Venezuelas, but you can have pretty high rates of inflation and kind of come out the other side. There have been examples of it in developed countries, and so to me, I agree with David. I think, I think we're likely to see at a high or a period of elevated inflation. My base case is not that we get this sort of Israel side of things. I think if things go sideways, that is a possibility. I think that's a tail risk. I don't think that's the base case. I think the base case, like David, is a period of stagflation.
Wow, very well said. And both of you had just so much to add. I really appreciate it. We're getting to about the top of the hour here, just past the top of the hour. So we're going to go ahead and wrap here in a minute. But I just wanted to say something to each of our panelists to thank you so much for coming and be a part of this, sharing your knowledge. I wanted to also, for those of you tuning in, the best thing you can do is tune into conversations like this. So we do have these once a month, the Bronson Equity Monthly Investor Series, where we talk about inflation or we talk about investing. So that's something you'll be notified about. Maybe, David, can you let people know how people can get in touch with you and a little bit about what you're working on right now?
Sure. The easiest way is my main website, themorganreport.com, to sign up for a free newsletter. If you're interested in the equity side, mostly in the resource sector, there's a subscribe tab. You can look at it, watch the video, and make a decision. If you're interested in what I'm following, I do most of my own Twitter posts. I do have a few people have access to my account. I trust what they post. Most of their stuff is on the humor side. If it's something serious in the economic system, revolving metals, industries, currencies, any of that stuff, it's usually me. So I don't have Web 1.0 anymore. The Web 1.0 is basically my Twitter account. So depends how in tune you are with the economic system as it continues to decline on an aggregate level. But there's ups and downs throughout everything. I'll just say that actually there were bonds in the Great Depression that paid. Many failed. So you could have done good if you chose wisely. And there were actually some startups in the Great Depression that became stalwarts later on. So, it's a human attitude. There's always an opportunity. Sure, during the crisis, and most people get depressed, but there's always opportunity. So, and I just want to shout out to Luke. Very succinct intellectual thinking. It was great to have you on the panel with me. I really appreciate it. In fact, steel on steel, I think you some of your answers helped sharpen mine. So thank you.
Thanks, David. Appreciate that. Luke, thank you as well for being here. How can people get in touch with you or follow what you're doing?
Sure, absolutely. Thank you for those kind words, David. As likewise, I really enjoyed chatting with you as well. It was a lot of fun. So, in terms of getting a hold of me, probably two ways best. First is our website, fftt-llc.com, and you can check out and see what we're up to and different types of product offerings, the type of work we do if you're interested in that. And then I've got an active Twitter feed at Luke Gromen, LukeGromen, all one word, and check out what we're saying there on any given day.
Awesome. Well, guys, thanks for joining. Just wanted to let everyone know here, I also have a free giveaway for everyone. This is an ebook that I wrote called The Single Best Investment Strategy During and After a Pandemic. It talks about multifamily investing. We have about 120 million in real estate. We've helped a lot of investors get into real estate. Also have conversations like this on an interview show called the Mailbox Money Show. So hopefully we'll have each of you, David and Luke, on the show as well, talking about inflation, talking about metals, things that are close, near and dear to my heart. So thank you, each of you, our panelists, for coming and joining today. And thank you as well for those that took time out to educate yourselves, because that really is the best education that you can make. So we'll look forward to seeing everybody next time. And thank you again to our panelists. Everybody, I hope you have a wonderful night.
Thank you.
Thanks for having us on.